All right, folks, and welcome to our guest speaker event. Today, we're going to be focusing on alternative investments with Charles De Andrade, and we hope that this session will be insightful. I think Charles is going to cover a lot of information on this new space, the alternative space, which I know it's also growing. It's a section that has been attracting a lot of investors, a lot of family office into this space when they're looking for other alternatives away from public markets. With that being said, I will let you take over, Charles. I know we have a decent size of audience. And for those of you that are here, we are recording this session. We are going to upload it also to the platform so that you have access to it and you can go back and replay some of the concepts and information that Charles is going to share with you today. With that being said, welcome, Charles, and I'll let you take it away.
Yeah, thank you so much, Luis. Pleasure to be here today with you and the attendees, and hopefully it's going to be an insightful session and an approachable session where I'm happy to answer questions, obviously, as we go and keep it accessible. But yeah, excited to talk about a space that I'm very passionate about, and I've worked obviously an extended amount of time in, and I've sort of built my career in. So happy to share perspectives from that regard, but also answer questions and any sort of insights that I can share. Happy to do so. So with that said, I guess let's get into what we're going to cover today. First of all, it's obviously a pleasure to be back with you guys. Some of you may have joined the previous webinar where I spoke about IB and PE career tips. If you haven't, I believe the recording is available through the platform, so please go check that out. But today, I'd like to basically center the focus around alternative investments. As Luis mentioned, vastly, rapidly growing space, and a lot of ground to cover here, so I'll try and keep it accessible in that sense. As I mentioned, it's an area that over the course of my career, I've gained a lot of experience in and exposure to, not just from a practical, actual application perspective, but also from a theoretic and academic perspective. Obviously, I'm a CAIA charter holder, and so that speaks to that as well. And so excited to cover that. The structure for today is essentially two blocks. In the first block, I'd like to cover the alternative investments. So this sort of covers the full gamut and serves as an introduction. And then in the second block, I'd like to take a deeper dive into private real estate, which is an area that I actively work in and have built experience in and can share a lot of additional insights on as well. And so for those of you maybe not necessarily familiar with my background, I want to briefly sort of cover that as well. I essentially have over 15 years of real estate investment banking and private equity experience, and have completed over $5 billion worth of capital raised or placed or transacted or invested in various private equity real estate structures and vehicles. Most notably, for some of those that may be based in the US, I've worked on the multi-billion-dollar American Dream mall development in New Jersey, pretty much just outside of New York City, where I was on a team that placed a $2.7 billion construction facility, as well as raising additional capital from bond providers. And then my group itself partnered with an institutional pension fund and invested into a $225 million bridge loan for the same construction of that mall. Additionally, I worked on other large-scale development projects as well, notably Cambridge Crossing in Boston, which is another multi-billion-dollar development, and the Grand in downtown Los Angeles, developed by Related. And so, in addition to these development projects, I worked on numerous other private capital raises and real estate investment capital raises and advisory assignments. And so, from that regard, have been in touch with exactly sort of these groups that we'll cover today, the institutional investors, the pension funds, the allocators, as well as these private operators and sponsors, as we call them, that really take the ownership and the development and the management of these assets under their wing. And so from that regard, I'm happy to obviously share those insights over the course of today's webinar. And as I mentioned, happy to answer questions. I'll probably do one big pause at the end of the alternatives block and then maybe another pause in the real estate block. But if there are any questions, feel free to submit them in the chat, and I'll try and pick them up as we go. So the alternative space. I know a lot of you guys or attendees here today have probably heard bits and pieces about alternatives, especially if you're interested in investment banking. One area that you're likely familiar with is private equity, as that's kind of the default exit option, if you will. But alternative investments span a lot more than just private equity, and so we'll get into that today. But I'd like to start with the sort of traditional investment offerings and the traditional investment landscape. And so, as you'll see on the slide that I put up, essentially different investor groups over time have built sort of different preferences and investment models, right? Ranging from your pension funds, where those groups are more interested or focused on managing investments to a certain yield, right? To coverage pension liabilities, or insurance companies, right? Which manage capital more towards anticipated liabilities. But you can also have, in the investor side, sovereign wealth funds that manage more for generational wealth or maybe government funding assistance, or endowments, right? College endowments, who manage more towards certain spending yields that they can then apply towards scholarships, or college operations, or maybe expansion of the college or college campus. And then finally, you also have foundations who manage more towards certain spending or charitable goals. Those are sort of your large default sort of institutional allocator groups. And then you have the sort of smaller groups behind that, to Lewis's point in the introduction, consist of mostly family offices and high net worth groups, where they're managing family capital, right? As an example that comes to mind is Michael Dell, the founder of Dell Computers, has a vastly successful and large scale family office where he manages his private wealth, right? And some of these other high net worth individuals have done the same and manage capital and investments through their family office vehicles. And so those are also institutional players in this sort of investor landscape. Obviously, most people or everyone will be familiar with traditional investments, meaning default stocks and bonds, mostly publicly traded and available on the large stock exchanges and public markets. And as of today, these categories, so meaning stocks and bonds, still comprise the vast majority, right, of investment products in the global investable market. So CAIA aggregated these stats here. And so at the end of 2020, the global investable asset market totaled to around $153 trillion. This is globally, of which from that in that market, equities and bonds, as you can see here on the pie chart or donut chart, comprise the vast majority, right? Like over 85% of all products within that sphere. And you can see in the light blue shaded area on the top that alternative assets, which we'll cover, consisted or comprised $18 trillion or 12% at the end of 2020. And that's really a factor in part due to the novelty of the space, right? So alternative investments weren't really widely available since or before the 1980s, essentially. And so in the 1980s, with legislation changes and macro and technological improvements, alts really sort of became more mainstream, more accessible, at least to institutional investors at that point in time. And that really coincided with a certain CIO, David Swensen, who's sort of seen as a leading figure in the world of alternative investing, and used to be the CIO of Yale University Endowment. He, I think, unfortunately passed away a few years ago. But he at Yale really pioneered what was referred to as the endowment model. And this is really a view where some of these endowments and these private groups that I mentioned at the start, they really are unique in a sense that they're not necessarily your short-term investors. So, and by that, I even mean contrasting that to a personal retail investor, right? So for those of you in your 20s or 30s or older, you're likely looking to invest in some capacity to build assets towards retirement, right? So that is, call it a somewhere between a 20 to 40 or so year horizon. And while that may seem very long, it is actually relatively short when you compare that to large-scale pension funds or sovereign wealth funds who are not just managing assets for essentially one lifespan or a period of one lifespan, but are managing assets for really multi-generational purposes, right? And so that extremely long dated window kind of leads itself to being more open and accessible towards private investments that may not necessarily be as liquid may necessarily not develop or realize a return within a certain number of years and may take decades to develop. And so think, for instance, as a good example of that, infrastructure projects, right, where the development of an entire grid or a high-speed rail line or an airport, it's not generally something that is done and completed and stabilized and operational within a 3 to 5 year period, right? We're talking decades usually of approvals and processes and large-scale sort of development efforts that have to be undertaken for that to be realized. And so naturally, those projects are going to lend themselves more towards groups that have that sort of ability to commit capital longer term, right? And so David Swensen at Yale really pioneered this because of, in part, the perpetual nature of the Yale endowment, and also the smaller liquidity needs, right? Like these groups are not necessarily dealing with liabilities or spending goals that require sort of a more liquid investment base. And so that also is helpful in the sense of shifting that focus towards longer term assets. And so Swensen pioneered the theory that a well-diversified portfolio should invest in non-publicly traded or private or illiquid securities, and that active managers can then extract alpha above and beyond what managers in the publicly traded realm can achieve. And so the premise, again, is really that patient investors with essentially longer horizons tend to have a relative advantage in that sense. And so as a result of that, Yale's endowment was really sort of the leading group or endowment that heavily focused and allocated towards alternative assets and really pioneered infusing that in a portfolio. And then over time, the data and the returns data started showing that it could be a lucrative strategy, right? And so it started carrying over to other similar groups and other institutional investors. And so as a kind of data point, during 25 years of managing the Yale endowment, Swensen actually achieved a 12.5% annualized return, which over the same time frame outperformed the S&P 500 by 280 bips. And so he was able to essentially successfully outperform the S&P 500 by infusing alts into his portfolio. And as we'll cover today in the next few slides, I'll share with you some of the reasons and the characteristics and the traits of why he was able to achieve that performance and why there's a case for alternative investments to be infused inside these sort of traditional portfolios. Briefly on the size and the growth on alternative investments. As I mentioned, technological advances and legislation changes have contributed to essentially the space rapidly growing, but it's also a function of various groups entering the space. And we'll talk about some of the new innovation things that are happening that I find personally very exciting in the space as well, and how much more accessible it's becoming and how much more esoteric it's becoming from an investment as well. But alts currently comprise, as you can see on the slide, and I mentioned 12% of the global investable assets, but it's actually on track to double in that size by next year. So in a matter of 5 years from 2020, since this data was last aggregated, to next year when the data is anticipated to come in at essentially double the market share of global investable assets. And so that's very rapid growth. And one thing I find interesting, and obviously I'm biased because I'm in the space, but this may be interesting for others considering entering the space or getting more knowledgeable about the space and potentially looking to one day work in this space. While alts currently comprise only 12% and on track for 25% of the global investable market, when you look at fee revenues and income streams relative to what the other investable categories are generating in terms of fees, alts actually take a 50% or so share of global investable revenue driven from fee streams. So that suggests and shows that alts as a space is a much more highly compensated space, if you will, because of generally higher fee loads. And the generally higher fee loads are there because the market is a lot more opaque. It's a lot more illiquid. And so there's a lot more manager skill and manager oversight required versus your typical markets. And so from that perspective, for those of you thinking about compensation or growth of the space, it's obviously very positive to see that whilst it's still a minority share of global investable products, it is on track to actually take on the majority share of revenue generation within the space. And so for those of us who work in alts or ambition to work in alts, that's obviously a positive takeaway. So what exactly then comprises alts? And again, some of you guys or attendees today may have had exposure to or have heard of some of these groups, but I'd like to do a brief run through and give an introduction as to what sits inside this sort of investment niche. So as you can see on the chart, I essentially broke down the $18 trillion of share of global alternative assets in a category by category basis, and I can run through the categories and give you a sense of what sits where and what exactly it comprises. And so at the top, as the largest sort of subcategory, private equity takes a $6.5 trillion share, or about a third of the $18 trillion global alternative asset share. And that's not surprising. It's obviously the most prevalent and most known sort of category. I probably guess that most, if not everyone on this call, will be familiar with PE, and then the sort of two sub-disciplines within PE being venture capital or VC, and leveraged buyout or LBOs, which are essentially take private strategies, or more the classic PE when most people think about PE. And then VC obviously being focused on angel or early stage seed investments in newer or startup companies, with obviously the objective to grow those businesses and exit through sale IPO. So I won't spend too much time on PE given most people's familiarity, and move to the second category. So the second category, hedge funds, is undoubtedly something that a lot of people will have heard of, but may not necessarily know all the different sub-strategies and sub-elements that comprise PE, hedge funds, sorry. And I'll briefly go over them for benefits of this webinar today. So hedge funds essentially can be seen as less regulated investment vehicles, where the lesser regulation, because of generally the higher level of sophistication of the investors in these products, leads to a wide variety of different strategies and different viewpoints that can be employed and effectively managed or executed within these hedge fund vehicles, right? And so generally speaking, most hedge funds will sit in one of the buckets that I mentioned on the slide. So that's macro managed futures, event-driven strategies, relative value strategies, equity, and fund of funds. And so I'll briefly walk through each of them. So for macro strategies, most people will kind of have a sense when they hear macro, it's exactly that. It's speculating on certain macro events globally. And these can be either systematic, so computer-based trading comes to mind, or they can be fundamental or technical based, which is more analysis driven, sometimes technical analysis driven, which is more sort of tracking stock trading patterns and pricing over time. And then within that, in that macro category, focused on macro, so think, for instance, country or currency or monetary events, and then trying to capitalize on that. So taking a step back briefly here, most people will probably think, hey, you mentioned alternatives are not your traditional investments. And here we are talking about hedge funds. And then the first thing you talk about is publicly traded stocks and strategies, how to trade those stocks. And yes, that's absolutely true. So it is possible, or in this construct, you should I guess keep an open mind that whilst alternatives are typically your non-traditional assets, so your non-stock and bond investments, certain alternative vehicles can themselves invest in these traditional products, but they're considered alts because they're applying a different strategy or a different rationale to investing relative, or as opposed to your more traditional investing, where you're buying a share of Apple or a US Treasury and holding that for an amount of time. And so where it pivots into the alt sphere is where those products are taken and a layer of strategy is applied above and beyond those to sort of complicate from an investment perspective what is actually going on, but from a returns and strategy perspective, execute a certain view to realize a certain profit that you wouldn't necessarily be able to extract if you're just buying and selling sort of your traditional investments. That is key to keep in mind. So macro strategies do exactly that. They capitalize on a certain viewpoint, a certain differentiated view, where whoever's leading that hedge fund or that strategy is seeking to essentially see that vision come to life and bank on, once invested, bank on capitalizing on that return dispersion or convergence or whatever the strategy is. And so as an example of these macro funds, this probably precedes everyone on this call, including to some extent myself, But a good example is George Soros and his Soros Quantum Fund in the 90s, where a lot of investments were made sort of speculating on the European, this was pre-Euro even, currency movements of different countries. So if you want to read more about macro strategies, I think that's an excellent place to start. And obviously Soros has been wildly successful in executing those strategies. Pivoting to the second category here, managed futures kind of sits within macro to a certain extent. When someone says macro managed futures, this really pivots and shifts focus towards a number of commodity products that are traded on a futures basis. So commodities and sort of agricultural products and those of the like tend to have a certain curve, almost like a yield curve where for those of you familiar with sort of basic finance, a yield curve is essentially a curve of different yields for different maturities of different debt products, right? And so it's a tool to get a sense of what a longer dated bond product may trade for relative to a shorter traded product. And so that same concept applies to commodities as well, where the price of call it a barrel of oil or a certain amount of grain or corn, et cetera, is to an extent predictable based on a curve. There are certain visions or views on what a barrel of oil will cost 1 year out into the future or 5 years into the future. And so based on those projected pricings and future contracts, one can then trade on those prices and obviously short or long those positions or apply a variety of exotic strategies to basically execute a view on wherever you feel that price is going to evolve to, and then take that position to capitalize on it, right? And so managed futures do exactly that and span the agricultural commodities that I mentioned. So corn, grain, et cetera, is all futures traded. It can also be your more sort of typical commodities such as gold and oil, et cetera, and can be wildly lucrative again. Moving to the next hedge fund category, event-driven strategies. So event-driven strategies are generally speculative around certain corporate events. So you can have, for instance, a mergers and acquisitions strategy where once a merger gets announced, someone with a viewpoint on whether that merger succeeds or not can take a certain position. Typically, that's buying along the target company and shorting the bidder company and banking on if that merger is profitable, those share prices converging and essentially capitalizing on that convergence. Obviously, the risk is there that if the merger does fall apart and those prices don't converge, you're exposed if you don't hedge that position. And then obviously that would lead to a loss. And so these event-driven strategies generally focus around that, but not necessarily limited to just M&A. They can expand to reorganizations as well, special situations, distress situations, or bankruptcy, where you're essentially applying the same rationale, right? Like whether or not a company or a stock will essentially go through a successful bankruptcy or not, or reorganize, or come out of a distress situation, and you can speculate on that. Or you can even speculate on taking ownership or a certain stake in the liquidation of the companies by aggressively or almost from an activist perspective, acquiring certain positions, right, and trying to execute on that. So you can see a lot of sort of the activist investing for the investment banking or finance people on this chat today that are kind of your movie fans and sort of carrier fans. This goes to sort of the original Wall Street movie, right? Activist investing and trying to secure a position within a firm, which then leads to certain voting block that you can execute and try and get people on the board and essentially influence a company. You can see those types of event-driven strategies as well. Moving to the next category here, relative value. So this is probably a bit more opaque, doesn't necessarily immediately ring a bell to most people, I would think. But relative value is generally focused on capturing a return to or a development towards a pricing relation or a spread between two securities or more. So essentially, generally these strategists or these investment professionals that execute relative value strategies will look at a certain spread or a certain relation that historically has held over time. And then as they monitor that, when they see a dislocation and that spread widening or tightening or that relationship being off in some sort, that then potentially provides an opportunity to take an investment position. Again, this could be a simple buy and hold strategy, but this could also be most likely a long, short, or combination strategy and putting in place essentially an options package on top of the investment to hedge or execute a certain vision. And then the premise here is that that relationship that historically held around a certain bandwidth or parameter, even though it's currently dislocated or not where you would anticipate it to be, that based on putting in place those investment tools, ultimately you're banking on the fact that that relationship restores itself. And then once it's restored, you can capitalize on those positions and realize some profit. And so these strategies can include convertible bond arbitrage opportunities. They can include more exotic products towards speculating on volatility relationships or volatility in stock derivatives. And this, I would say, is really one of the areas where it can get very complex very fast, and where there's a lot of different options and very exotic option strategies that get executed within this sphere. And so today's webinar doesn't lend itself to cover those, but for those of you interested, definitely look into it. And it's a longer track to get up to speed on that. Probably, I would say, one of the longest tracks, given just the level of complexity that sits within this space. And then to close out the hedge fund strategies, you have your equity and fund of funds. Equity is essentially, probably should have started there, is essentially one of your more basic hedge fund strategies, where this just involves taking any position or any viewpoint around your traditional stocks, and then layering in different stock options on top of that. So this can include tracking certain market anomalies, anticipating larger movement or trades. There's groups that follow certain larger groups and that publish research or take positions and then try to mimic those positions or take counter positions to that. These are groups that follow and track, sometimes on an automated or these days increasingly with an AI assistance, track certain news releases or certain data points, and then based on those data points or shifts, they take certain positions in companies. And so this can really sort of open up the full gamut towards basically executing any viewpoint on any stock at any place in the world. As long as that stock is publicly traded, you can layer in a strategy and try and execute on your viewpoint. And then finally, fund of funds, also a very straightforward bucket, essentially a combination of pretty much all of the above. So fund of fund is really sort of almost like a mutual fund, if you think about it on a simplistic basis, where it's an investment bucket that then houses a number of individual hedge funds within that structure. And that can have the benefit of obviously that diversification, but it can also have the benefit, given the hurdles to be able to invest in some of these hedge funds, of accessibility. So investing through a fund of fund, because they're pooling capital and they essentially have a number of investors within the fund of fund, and then have a certain allocation that they can put into this one macro fund or this one event-driven fund. Because of those allocation sizes, they now qualify to access those funds, whereas as an individual investor, you may not necessarily have the 10 million plus or $100 million plus that some of these funds require to be able to access these funds. And so that's a benefit. One of the negatives about a fund of fund is mainly the double layer of fees. There's obviously the individual fees on the individual funds that are invested in, but then to provide that oversight and that management, there's a second layer of fund level fees. And so as an investor, you're essentially paying 2 layers of fees. But again, it comes with the benefit of maybe getting access to some of these funds that typically, as a smaller investor, you may not be able to access. I don't see any questions so far, so I'll move to the next category. So the next category is an area that I'm obviously much more aligned to, and it's much more in my wheelhouse, which is the real asset category. And so real assets essentially comprise all the tangible assets. So think real estate, natural resources, commodities from the sort of non-futures trading perspective, infrastructure and other assets such as farm or timberland, but also intellectual property. So most people will probably have guessed the categories I just mentioned. But intellectual property is usually one that doesn't necessarily immediately come to mind, but it's probably the most, at least from my perspective, the most exciting and interesting sort of novel category. So within that, think truly esoteric investments. So think patents and patent investing. Think investing in movies. So people investing in buying movie scripts and having essentially an option whether or not to produce that movie and potentially realize the profits for that. And then most recently and rapidly growing and expanding, investing in art and certain collectibles such as wine or sports memorabilia has become accessible and has become a category as well. So this is something that personally, as a big sports fan and someone who appreciates that, is just very interesting from my perspective to see. So You have companies out there today, such as a platform called Masterworks, who essentially have commoditized investing in high-end collectible artworks. And so there is now a platform in the sense of Masterworks where one could buy a share in a Picasso painting, for instance, and as that painting gets traded in different auctions privately, you can realize a certain return based on that percentage ownership that you have in that painting. And so that's really interesting to see from my perspective, and wild to think that that is now opening up as a form of investing as well. And that carries over into categories such as wines as well. It carries over into categories such as sports collectibles, where you have another company by the name of Rally, and they essentially apply the same model. And there you can invest and own a piece of a tradable baseball card from a major sports figure, or I've seen sports sneakers. I think Rally even do things as owning a portion of a vintage sports car that is priced at an insane valuation. And so those high-end, highly desired, very unique collectibles are now, in that sense, democratized and commoditized to the sense where one can buy a share of a vintage Ferrari or of a Michael Jordan shoe or Derek Jeter baseball and invest in that and basically execute a vision of, I think that this collectible is going to increase in value by X. And so if I'm owning a share of that, similar to owning a share of, in the traditional investment sense, a share of a company such as Apple, it can diversify your portfolio, but also at the same time, from a hobby and interest perspective, align your investment with something that you're maybe personally passionate about. And so it's amazing to see those innovations and to see the space really evolve to that. Real assets essentially comprise sort of that and continue to grow in that sense. And then the final category in this slide is private credit. So private credit or debt is a bit more traditional and has gained sort of in popularity recently, mostly driven by the recent surge in interest rates, obviously. So it's become a bit more lucrative in this higher yield environment. And so this category can really include real estate debt, if you kind of pivot out of the real assets, but also broader asset-backed financing. So think balance sheet collateral positions to issue private corporate loans on inventory or accounts receivable or things of that nature, but also expanding to fund, for instance, LBOs and M&A loans to put those structures in place, such as an example that comes to mind is the debt facilities, for instance, that were provided to Elon Musk for the Twitter acquisition, right? And so that's also considered private credit. And this really ranges sort of all tiers of subordination. So from senior down to highly subordinated or mezzanine positions, and they span across sort of different strategies as well. So think from distressed debt, restructuring facilities and bankruptcy facilities to non-performing loans and speculating on that. And so it's really an interesting, very diverse bucket, and sits sort of separately as it focuses on credit. And then there are a couple of sort of holdovers. There's a separate category for, and it's a relatively minor position. That's why it's not on the chart, for structured products. And these are sort of a separate set of more exotic investment options and investment structured products as well, which take a smaller chunk of the alts investment space. No questions so far, so I'll move to the next slide. So now that we have a sense of where alts sit and what sort of different products sit in this alt sort of world, right? The red line across all of these sort of alts products is a number of characteristics that most alts tend to have and tend to show, and I'll walk through that in this slide here. So I've essentially selected your kind of key characteristics or key sort of points to take away from when you're looking at alts and what sort of the nature of alts are. And so aside from, again, alts being sort of the label to all non-traditional stock and bond investments, there are a number of characteristics that tend to hold across the different alts, right? And so first, alts provide a strong diversification element to an investment portfolio. So going into general finance, think sort of Markowitz efficient portfolio frontiers and basically portfolio theory, so MPT, where essentially you're looking for the combination of assets in a portfolio that gives you a more efficient frontier. And the more efficient frontier is kind of the best point where you're investing and getting essentially the most return for the risks you're taking out of your investments. Alts, given that they're typically low to non-correlated to public markets, and as a secondary factor, given that alts within themselves are lowly correlated to one another as well, tend to add to the diversification. So taking a step back and going to that efficient portfolio theory, for those of you not familiar, any asset that is essentially not perfectly correlated with another asset, once I add that asset to a portfolio, you're essentially increasing the efficiency of the portfolio because those assets are not moving in unison. Obviously, both assets are identical and move in unison. I can add 5 of those assets, but they all move in unison, so I'm really not diversifying, right? And the diversification comes in play because of adding these lower correlated assets. And so to see that characteristic within alts is kind of really the driving force behind adding an alt to a portfolio, then reducing that cross-portfolio correlation, and as such, yielding the benefit of that diversification. And then as a secondary category here, or a characteristic here, alts tend to be a bit more illiquid, which is another character. And so this privately traded or non-traded nature automatically implies obviously illiquidity, but it can have both benefits and negatives. A negative can be that volatility can appear less, especially with alts, but in reality is actually higher. And so this is known as an effect labeled as smoothing. For anyone looking at alts, this is a very key concept, and everyone should be looking at alts, should be familiar with this. So essentially, to kind of unpack this, if you have a publicly traded stock, right, such as Apple or any other publicly traded stock on a stock exchange, that stock is traded thousands, if not millions of times throughout a day, and is sort of instantly liquid. I can get a price, and the most recent price and an accurate price, because it's the market buy, sell, demand function at any point in time throughout the day. Even post markets, there's a post market close price. And so these are highly liquid, highly immediately priced assets from that sense, where, as you can sort of intuitively guess, as that price moves a million times throughout the day, that obviously has a certain volatility, right? And it shows a certain volatility. Privately traded assets, taking, for instance, real estate as an example, are not traded nowhere near that frequency. And so that inherently brings a lower level of volatility, right? If I buy a home, as a simple example, if I buy a home today, I'm not retrading or repricing that home tomorrow, or even within that same day. I'm not trading or repricing that home 1,000 times, right? I may look at what that home is worth, or kind of get an assessment of value if I look at an insurance quote 3 or 4 years from now. Or if I look to maybe sell it 3 or 4 years from now, I may get a broker to come and tell me, look, what is my home worth based on comparables, right? So within that time frame, I'm not necessarily seeing or capturing the value changes of that home. It's not an instantly traded stock where I can go to any website and get the price as of that second, right? And so that inherently lessens volatility. And there are a number of different statistical techniques to undo that and adjust for that, which this webinar won't allow to cover. But it's something to be mindful of, that the smoothing, the inherent smoothing of privately traded, infrequently traded assets should be something you should be mindful of anytime you see any stat regarding volatility or performance of alternatives. And most institutional groups or research will adjust for this by those unsmoothing techniques. It's just something to keep in mind. So going back to sort of the core argument around illiquidity, a benefit of illiquidity on the other side can be a statistical element referred to as an illiquidity premium. And while the research on this is not conclusive, there's an intuitive kind of understanding or rationale behind that, where the longer you part with an investment in terms of capital, the more yield you should theoretically get for that investment, right? So in essence, the illiquidity premium can be, at a very simplified level, can be described as almost comparable to a certificate of deposit, where if you invest your money for a year, that is going to yield you a certain return. But if you part with your money for 5 years, you're going to get a higher return, generally speaking, if all micro conditions hold, relative to investing for a year and then reinvesting for another year, and so forth and so on. And so that illiquidity premium, whilst elusive from sort of an academic or theoretic perspective, is another argument where, because these investments are more liquid and longer dated, there is generally at least a pursuit of capturing that premium. moving to the next category, alts further tend to display non-normal return distributions. So those for those of you comfortable with statistics, you would have heard or seen the normal sort of bell curve and the standard deviation dispersion of returns, which the normal shaped curve typically holds for traditional investments, especially on the long term. But alternatives, given this kind of more esoteric nature, alternatives can have characteristics that don't necessarily fit in that standard bell-shaped dispersion curve, and can have fatter tails, which is referred to as kurtosis, which typically means a higher probability of extreme outcomes. So think that standard bell curve, but then the ends are just sort of higher up. And those ends being higher up are essentially a higher probability of extreme outcomes, right? So either losses or gains can be far more pronounced with alternatives. But they can also be thin-tailed. So you can also have the reverse, where instead of the normal bell curve, these tails are thinner and you have a lesser risk of loss, both or gain at both the extreme end of the spectrum. Another factor here can be skewness. It can be positive skewed or negative skewed. So positive skewed dispersions have a larger right-hand tail versus negative skews having a larger left-hand tail. And I know this is maybe getting a bit technical for people that are not as statistically inclined. But essentially, a positively skewed right-hand tail is the potential for frequently small losses and a few number of very large or significant gains. So this is a more desirable characteristic, obviously. Negatively skewed dispersed investments have a larger left tail, and that displays some large or very extreme losses and then more frequent small gains. So to give an example that make it a bit more tangible, commodities tend to have a negative skew and high kurtosis. So it's high volatility product with low average returns on general. Whereas venture capital, for instance, can sit towards that positive skew territory where there is frequent losses across the board. But then if and when an investment in venture capital succeeds, it could be a potentially extremely large investment realization and potentially those unicorn valuations that you hear about, right? And so that's sort of a good sort of framework to think about the dispersion here. But more importantly, because of these differences in the distribution, standard deviation may not always be a good sort of barometer, because standard deviation here, especially for different products of alts, can be differently distributed. And so you cannot necessarily get the consistent sort of comparison, as we'll get into more detail in the next few slides. To round out this slide in terms of characteristics, there is also inflation beta. And so inflation beta is essentially the characteristic where select alternatives can serve as an inflation hedge of sorts. Two things that immediately come to mind and are probably most easy to understand are commodities. So commodities are actually a core component of CPI, not just as a standalone basis. So like oil literally is a component of CPI, but also think ancillary and derivative products, right? So if energy costs are higher, that then trickles through in terms of transportation and distribution of goods, which then ultimately trickles through to the end price of goods as well, right? So it's almost a double effect where within the CPI, you have commodities driving a core chunk of it, but then the derivatives of those commodities drive things such as pricing at the supermarket goods being higher, right? Because of the distribution chain and getting that product from A to B, but also even before that, manufacturing costs being higher given higher energy, right? And so it's really a core component. And so because it's a core component, commodities obviously capture inflation. But also within real estate, sort of a bit more opaque, but within real estate, a lot of buildings and a lot of sectors have shorter term or annual leases. So think, for instance, your own rental contract, if you have a rental apartment where the rental price you pay today, once your lease is up, you're going to get a lease renewal offer, and that lease renewal offer is going to factor in some compensation for the increased cost that the owner of your building is facing and where the market is trending to. And so that resetting of pricing on an annual basis allows a category such as real estate to also capture a portion of the inflation that is taking place in the market. And so those investments then, because of that happening at the sort of base level, then from the investor level or the institutional level, are capturing the benefits of those price movements and offsetting that versus traditional investments not having that and actually getting hurt in that sense by inflation. Then in terms of manager alpha, to round out this slide, we've spoken a lot, or I mentioned a lot, the opaque nature and the infrequently traded nature of private investments. And then you have your sort of more complex ones, such as the ones we discussed within the hedge fund space. And these are not your sort of vanilla traditional investments. These require another layer of insight, of capabilities, of technology, of structuring, of oversight. And so typically that then positions the space naturally for managers and manager skill to have a large impact. And as we'll see on the next few slides, there's actually quite a wide dispersion between your top and your bottom managers and their skill sets as they apply them to their investment strategies. And then ultimately realizing differentiated returns from a benchmark or from a standard market strategy. And so that is an absolute key component of alternatives, and the ultimate manager selection for the fund or the products you invest in can make a vast, vast difference in the ultimately realized return. And so we'll get into more detail in the next few slides, but definitely a key component to keep in mind as well. So to show a couple of data points and a couple of charts to sort of illustrate these components, wanted to go over some data that I've sourced from various institutional research groups. So here you can see the essentially diversification power of alternatives, and JP Morgan Asset Management, essentially what they did is over a 30+ year window from 1990 to 2023, they comprised bond and equity portfolios across different mixes. So these are the dark and light purple shaded sort of dual charts that sit on the bottom spectrum here. So you have your 60/40 traditional portfolio, your bond and equity portfolios across that sort of bottom range. And you can see here almost the efficient frontier, right? So that bottom range of pie charts is your kind of traditional investment portfolio frontier. And then as you infuse alts, which is the kind of light purple fuchsia color here, you can see all those portfolios move from the right-hand bottom corner towards the left-hand top corner, right? And so towards the upper left of this chart is where you ideally want to be from a risk return perspective. And that is really best captured by Sharpe ratios. So for those of you familiar with Sharpe ratios, this chart will be a lot easier to read. But Sharpe is essentially used with most traditional investments and essentially takes your excess return, so your return over a risk-free rate, and then divides that by a unit of risk or volatility. So it's essentially your excess return per 1 unit of risk that you're taking within that portfolio. And so you'd like that excess return per unit of risk to be as high as possible. And so you can see from the Sharpe ratios that I added onto this chart that those traditional portfolios, to take, for instance, the 60/40 bond 60% bond portfolio and 40% equity portfolio at the bottom left, that portfolio went from a Sharpe ratio of 65 to 84 bips by infusing 30% alts, right? And so that as that Sharpe ratio improves and that efficiency improves within the portfolio, you're essentially getting a superior risk-adjusted return, as it's referred to, and improving the portfolio ratio. That said, as some of you will note that paid attention during the last slide, Sharpe ratios and that standard deviation comparison may not always be your most accurate measure. And that's because of the standard deviation and those non-normally distributed returns. But within this slide and within this category, it's a consistent bucket of alternatives. And so that facilitates it. And it's also a more intuitive ratio to use. But for more complex analyses, one can think about using a ratio such as the Traynor ratio, which is based on data, or the Sortino ratio, which is based on a benchmark return instead of risk-free, or even the information ratio, which is based on a tracking error, or another ratio, which most of you may have heard of, which is the value at risk, or VAR, which is kind of more of a risk or potential loss perspective ratio versus the other ones. And so there are definitely other statistical analyses that can be applied. But within this chart, it's a relatively straightforward comparison, and you can see the efficiency frontier essentially moving and improving towards the top left-hand corner. I also spoke about performance during inflation regimes and inflation hedging capabilities. And so this next slide shows some of the data here comprised by or composed by KKR and CAIA. So KKR, the top table, did some research around what a 60/40 bond portfolio and how that performed during sort of throughout all cycles, but then bifurcated those sort of cycle view data points into a high inflation and a low inflation regime, and then viewed at how those portfolios then performed. And as you can see here, the 60/40 bond for the equity traditional portfolio performed and realized a 0.73 Sharpe ratio sort of throughout all cycles, and then improved to a 0.96 Sharpe ratio in a low inflation regime, but deteriorated to a 0.12 Sharpe ratio in a high inflation regime. And obviously we're in a high inflation regime now, so this is highly applicable. And part of the reason for that is the fact that high inflation regimes tend to drive higher rates to combat that inflation, and higher rates in turn tend to drive higher discount rates as well for traditional stock valuations and essentially compressed valuations, right? And so that is a key factor, and there's some other factors that we'll get into on the next slide. But as this kind of performance gets distorted in a bond portfolio, infusing some of these alts that obviously can capitalize and capture some of that inflation, as I mentioned before, with commodities and real estate, then enhances that performance, right? And so as you can see in the KKR data, these alt-infused portfolios all perform better in both low inflation and high inflation regimes. So it's just more resilient, essentially, right? And then in the bottom part of this slide, I wanted to show the lessened loss potential from an absolute basis. And so CAIA did research around a metric that is often used in private valuations as well, which is called max drawdown. And max drawdown is exactly what it implies. It's the essential max loss at any point in time over that portfolio. And so if you look at the right-hand side of that bottom table, you can see the max drawdown over a 10 and 15-year window ending in 2023. And so for a public 60/40 portfolio in a 10-year and 15-year window, the max drawdown there, so this includes the GFC and whatnot, was a borderline 12 and a borderline 31% hit to the portfolio overall at any point in time, versus an alternative assets portfolio. And this is 100% alternative assets portfolio, so it's a bit distorted in that sense. But an alternative assets portfolio only realizing a borderline 9% max drawdown and 24% drawdown in that same 10 and 15-year window. So again, showing increased resiliency and robustness to some of the data points that I mentioned before. And then giving everyone a bit more insight into the relationship between stocks and bonds and correlation. So stocks and bonds actually have a unique relation where, as you can see on the right-hand side of this chart by Blackstone, historically in low inflation regimes, so this is kind of the gray dots on that dispersion chart on the right-hand side, in low inflation regimes, the correlation is actually very low or negative. And so that diversifying effect between stocks and bonds is actually working as intended. However, in higher inflation regimes, it shifts towards the sort of green dotted area on the chart, and the orange diamond is actually where the data is currently. And so that diversifying relationship no longer truly holds to that effect. And so that really deteriorates then those portfolios, and anyone that looks at 60/40 traditional investment portfolio performance versus alt performance will see 60/40 portfolios perform more poorly, mainly because of this reason. And then circling back to what I mentioned on the higher rates driving higher discount rates for DCF valuations and whatnot, that you can really see on the left-hand side of this chart, where the higher discount rates are driving lower multiples, right? And so the higher the inflation, the lower generally the multiple, which is an intuitive relationship that I think most people will be able to gather. And then finalizing this block with one more data point, I mentioned the manager dispersion. And so I wanted to share this slide as well by the CAIA Association, where across the different alternative investment strategies, such as VC or real estate, you can see in this box and whisker chart the differential between a top 5 and a bottom 5 performing manager, as well as obviously the median, bottom quartile, et cetera, in the box itself. And so if you look at VC on the most left-hand side, you can see that dispersion is pretty much almost like a 30% range, right, between that top and bottom 5%, purely based on the manager who's executing the strategy. And then lesser complex or intrinsic categories such as senior debt, which is in that sense, quote unquote, more vanilla, right, has a lesser dispersion, right? So that's about a 10 to 15% range between the top and bottom managers. But that said, across the board, as you can see here, the difference between going with a very highly skilled insightful top manager versus maybe a lesser skilled or not as insightful manager, it can be quite wide, and so is absolutely a key item to consider when looking at alternatives. I'll look at questions, which I don't think there are any at this point. And then I wanted to share one more thing before we move to real estate. I think I mentioned this during the investment banking career session, but for those of you looking at jobs in investment banking, one of the key pieces of advice I gave in that webinar is to stay informed and try and track and read different types of research. I would personally recommend to try and get your research or read things that are from an official or institutional source. So sources that you could go to are the CFA or CAIA blog, which are excellent sources. And then there's one free research platform that I mentioned last time that I wanted to reiterate here, which is essentially also where I source these charts from that you just saw, which is savvyinvestor.net. They're a completely free platform. And what they do is they curate a lot of these institutional allocator reports from the KKRs and the JP Morgans and the Blackstones of this world, and make those available to the public. Again, you can sign up for free for an account. And I feel like, in my opinion, that is really a great source to get extremely high quality academic or institutional information, as opposed to maybe following certain blogs or social media where you're not necessarily sure whether that information is qualitatively high grade or not. And so I would definitely recommend for anyone interested in reading more to go on there. You can find the full reports from which I pulled these charts, but you can also obviously gain the benefit of that ongoing education and the ongoing insights that can then help you in turn in networking or interviewing conversations and such. So bit of a flashback to our investment banking career session there. So with no other questions, I'll move on to the real estate section here. So real estate, an area where I'm obviously highly passionate about, given that it's my current career field and employment field and an area of expertise. And so I really wanted to take this next block of slides to give everyone a good overview of the different core components within private real estate, the different mechanics. And so at the end of this block, hopefully all of you will have a good high-level sense. And then if there are any follow-on questions, potentially we can do follow-on webinars where we dive into more detail. We'll pick apart certain components, but from a general overview perspective, this should be very compelling in terms of getting a good understanding of the space. And so when real estate is mentioned, obviously a number of buildings and assets and things come to mind. So I wanted to start with the formal sector classification. Obviously, everyone is familiar with real estate, but you may not necessarily realize which categories kind of all formally sit within this segment, right? And so what you see on this slide here is essentially an overview of the different sectors. And if you were to join a large bulge bracket firm or a certain group, these may be broken down into certain coverage teams. So there may be a team that covers only gaming and casinos. There may be a team that covers only office. And obviously, if you go to a REIT or any other operator, those tend to generally be more specialized, especially if they're larger scale. Whereas maybe some of the smaller PE shops can be either, right? They can be either hyper specialized on a certain sector, certain strategy, or they can have a broader focus and just be generalist and sort of touch all of these sectors efficiently as well. And so to kind of pick through and kind of give everyone a sense of the mechanics behind these sectors, because obviously from a high level perspective, everyone knows the difference between office and industrial building, but there's a lot more obviously complex analysis and differentiating factors that sit behind those product groups, right? So I'll kind of briefly walk through each of these components. So starting at multifamily, that's the most straightforward, right? Everyone's familiar with the analytical part where multifamily is obviously driven by annual rental contracts. That's all fairly straightforward. And so you have these annual leases for multiple tenants that just reset on an annual basis. And so the modeling analysis reflects exactly that, right? Making anticipations on where those leases are renewed and then modeling those out. It gets a bit more complex with product types such as office or retail, where they can seem easier on the surface because of longer dated contracts. So it's no longer that annual reset typically, which again, annually, you're going to have to make assumptions about where those leases are. So where you see a 5-year or 10-year office or retail lease, you think maybe on the surface, this seems easier because it's only one contract and it sits there for 5 years. But under the surface, they can actually be far more complex because of what a tenant reimburses, for instance, in operating expenses, which is kind of the norm within office spaces, where the tenant leases the office space, but also takes a share of the office building expenses. And there can be different structures and strategies around it, which can quickly complicate the modeling around it. Or on the retail side, leases are typically structured with what is called a percentage sales clause, where the tenant is paying a certain dollar per square foot basis, which you could see across pretty much most sectors. But in addition to that base rent, is also paying a percentage component based on how many sales they're realizing within that store space, right? And so that's a percentage of sales. So if there's a store that does X million in sales, then a percentage of those sales would be added on top of the rent, which again, from a modeling perspective, can quickly complicate the analysis around those leases and those projections. And then industrial leases is another one of the main sectors. So there's obviously 4 main sectors here at the top of the slide. Industrial leases can have things such as CPI escalation clauses, where inflation is really driving where those rents are growing towards, which can obviously be appealing for that inflation hedging characteristic that we covered earlier. But industrial leases can also tend to include triple net or dual net or single net structures, where essentially the tenant is taking on a part of the financial responsibility of the asset. So in the sort of max form, in a triple net lease, essentially the tenant is not just paying the rent, but is essentially paying all of the maintenance for the building, any upgrades, any other costs or operating expenses of the building. So the landlord is essentially holding a building where there's very minimal involvement from the landlord perspective in terms of spending or maintaining or operating the building. That's really sort of the tenant's responsibility. And so these leases are generally a lot more bond-like, right? Like if someone leases a space and that firm is then in turn in charge or responsible for most charges, that lease then becomes almost like a bond, like a corporate bond of sorts, where the viability of that lease and the performance of that lease is more tied to the credit rating of that overall firm. And so you'll see a lot of that analysis come into play for those types of leases. And then pivoting to some of the more niche sectors, you can have self-storage, obviously another category that most people will be familiar with, which is a lot more short-term, frequent turnover leases. You have a higher amount of units, so that can be a challenge to get a building to be fully occupied from a self-storage perspective and lease all of these small individual sort of boxes. But the more frequent turnover and the more frequent pricing then obviously has the benefit of it being a better inflation hedge in that sense, right? Adjacent to self-storage, you can have cold storage, which is a more specialized industrial niche, which is obviously, given the conditions and the sub-zero temperatures, often more expensive to operate, but can generally not just typically focus on just storage alone, but also expand to distribution or processing, right? So think meat or fruit repacking and ancillary services that can get incorporated into the analysis as well. And then you have other categories such as healthcare here. So you have your healthcare, which is sort of in this slide more denoting hospitals and care centers, but also kind of senior housing, which can go into assisted care or full care facilities, right? And those tend to shift more towards a per bed underwriting. So they're looking at it more as per patient, per bed, and then modeling out a rent in that sense versus a per square foot rent. And then factor in the additional healthcare costs and services that get added on. And so that per bed concept pivots into student housing as well, where it's again, because of the dorms and the setup there and usually roommates, et cetera, much more of a per bed modeling situation versus a per square foot or per unit modeling sort of concept. Then you have other categories that are kind of wildly different, such as data centers. So for instance, data centers are almost always completely non-square foot based. They're actually more so megawatt based. So it's almost purely like an energy play, where the amount of megawatts that are used by these servers gets totaled up and essentially drives the leasing rates. And then accessibility is key as well. So data centers are not the type of buildings that can be located sort of anywhere randomly. They have to be in proximity to obviously great energy supply, as well as connectivity to the sort of fiber networks that ensure that data transferring is happening at a high grade quality wise, and especially as AI becomes more prevalent and working from home is driving a lot of data usage as well. In addition to technological advancements, data centers are a vastly rapidly growing sector. Going into some of the other kind of esoteric categories here, you have, for instance, casinos, as I kind of briefly alluded to, and theme parks or resorts as well, where those categories in turn pivot more towards visitorship. There's a larger food and beverage component as well, an entertainment component, which is driving a lot of the revenue that these buildings generate. That gets modeled in as well. So it starts to mimic more maybe traditional company modeling on the IB side, as opposed to more de facto real estate modeling. And then with that, operators and brand names and sort of partnership contracts become more prevalent as well. So going as far as thinking that certain malls having quote unquote sponsorship deals where they're only serving Coca-Cola products or only serving Pepsi products, right? And that's a sponsorship deal that gets added on to the overall operation revenue streams of the mall and gets modeled out in addition to obviously those sales and maybe a percentage sales of those retail shops. And so again, another layer of complexity as opposed to traditionally modeling in typical rents. And then that's a good segue into hotels and lodging, which hotels and lodging have both that food and beverage and brand aspect to them, but also have this a very unique nature where rental rates are daily, right? Usually one can definitely rent a room for multiple nights, but those rates are typically reset and marketed on a daily basis, sometimes even more frequently, where the morning offered rates are lower or higher than the afternoon offered rates. And there's all kinds of pricing optimization models. But essentially, the modeling there gets a lot more complex because from an analytical real estate underwriting perspective, you're looking at an X number of hotel rooms where a portion is occupied and a portion is vacant each night, and that's on a nightly basis, right? So on a daily basis, you're modeling that out and analyzing the fluctuations. And then there's the ancillary stuff such as food and beverage, the restaurant or bar components that get utilized sometimes more frequently over weekends or events. And then there's also conferences and other events, weddings, et cetera, that can add additional revenue streams that are all modeled out and captured in that analysis. And so whereas real estate, again, may seem like a very sort of uniform category, and like, okay, you're just modeling out leases and rents. When you start to nitpick at these individual categories, there's actually a very differentiated skill set to underwriting adequately sort of each of these components. And so to round out our slide here, there's two other categories I wanted to highlight. So you have manufactured housing as well, which is a very unique real estate segment. It's actually the only real estate asset where the building or the structure itself depreciates in value over time. So generally, the premise with real estate is most buildings will appreciate in value over time, along with sort of all other macro developments, as most people sort of are aware or have seen in terms of personal home investing and buying. But manufactured housing, especially also because it's a personal residence, is unique in the sense that it's pretty much the only real estate category where the value of that residence, that mobile home, literally depreciates akin to buying a car. It's an asset where there's literally a Kelley Blue Book of sorts for manufactured homes, where certain brands, certain developments, you can tell this is a 5-year home and that's worth X. Literally the same as buying a Toyota car and knowing exactly kind of what the price point is after 3 or 4 years, which is very unique. It's completely counter to the other real estate products. And another differentiating factor as well is that a lot of these mobile homes, they sit on plots, and the plot is typically never owned by the mobile home owner. So the mobile home owner essentially owns this depreciating structure on top of the plot, but the plot is essentially operated and owned by the mobile park owner. So those are very key distinctions and maybe not necessarily advantageous, obviously, to the mobile home owners. And then there's a large difference in terms of mobile homes, and obviously most people instantly will think about trailer parks, et cetera. So that's definitely a part of mobile homes or manufactured home community. But there's a difference between the sort of non-age restricted ones, which can be that sort of trailer park stereotype type of situation, versus the age restricted manufactured housing parks, which can be much nicer and serve as de facto affordable rental communities. And you'll find a lot of those in Florida and the Southwest states. And they're generally much nicer grade, or almost like a mini gated community of sorts, and have other amenities and can actually be quite decent. Then from a cell tower perspective, that's probably the truly out there category on this slide. That can be either a standalone cell tower plot or can be an add-on. So think communication antennas on top of roofs or buildings. And those generally are contracted on a triple net basis, where whoever leases these towers takes care of the entire maintenance and operations and expenses with the towers, but pays essentially a utilization contract to that building or site owner to operate. So think, for instance, of Verizon essentially leasing that tower and operating everything around that tower, but then paying a certain amount of money to the sponsor or operator that owns the office building or tower in which on top that sort of communication tower sits. And so again, very different modeling nuances, very different analytical nuances. And so we can definitely get into detail on follow-on webinars, but hopefully that gives everyone a good sense of, on the surface, it seems simple, but in reality, there's a lot going on in each different category. So category and sectors are one way to break this down. Another way to break this down are different asset classes, right? So almost like a quality grade of assets. And so this is predominantly driven by vintage and geography. So the age of a building and the location. This kind of goes more back to your basic real estate components, right? Location and age and quality of the building are essentially everything. And so that holds in institutional real estate as well. And so in terms of location, it's usually bifurcated across gateway or primary markets and then sort of secondary and tertiary markets and everything thereafter. And so your gateway primary markets are obviously cities such as New York, LA, Boston, Chicago, Miami. And then your secondary markets can sort of be your more niche regional sort of hub markets. And then tertiary markets can sort of be anything beyond that, right? And so that's not to say that a building that's in a secondary or tertiary market cannot be high grade or high class. That's definitely not the case, but it is kind of a barometer or an indicator of where buildings typically sit. And then within that sphere, you generally have a dispersion between class A ranging to class D, class A being sort of your most premium category versus class D being a far lesser grade. And so as you can see on the slide here, there's kind of different characteristics. So going left to right, you have your use or vintage. Class A is usually brand new, newly developed, top of the line, has all the amenities, all the new features that one could want. Versus class D kind of deteriorating down to barely or non-functional, very old buildings, very dated. So even though the building may still be qualitatively good or sound, think of a building that has far smaller windows or corridors, or is just not kind of your more modern design building, which generally modern buildings in large cities these days have floor-to-ceiling windows and a lot of light and a lot of natural light and space and sometimes even outdoor spaces within the building, terraces and things of that nature, where older buildings may not necessarily have that, right? They may have smaller windows just given construction technology and where those things were decades ago. And so that obviously goes into quality grade and condition. Obviously, with age, condition generally doesn't improve. And so whereas buildings can be maintained to high standard and renovated over time, condition is generally going to regress. And so with sort of more of those issues, you're going to have to be at a lesser quality grade, and that's going to reflect obviously in rents one can command and the performance of that building, right? Then geography, as I mentioned at the start, location matters a lot. This is not necessarily being in New York or being in the suburbs somewhere. This can be within a city like New York, accessibility, right? If you are industrial property and there's a vast difference to being very closely located to one of the major ports or airports and having good access or immediate access to a major highway versus being located in a suburban neighborhood or outskirts of a neighborhood within New York, but being fairly far away from a major port or several blocks or sort of regular roads drive away from a major highway, which complicates the usability of that building, right? And so that goes into quality grade or class grade as well. And then finally, all these factors drive the tenant that is applicable for these buildings, right? So higher end, more quality blue chip tenants tend to flock towards your better quality buildings, class A and B, versus more price conscious or lesser grade tenants by necessity kind of sitting in that class B to D range, right? And so that's something to keep in mind. So generally when industry professionals refer to certain qualities or certain building qualities within real estate, it's generally denoted by these classes. But before I go to the next slide, a key takeaway here is that it's not always as simple. And I've tried to simplify it on the slide, but to kind of as a brain teaser of sorts to the group attending today, think, for instance, about the challenge of how you classify a building such as the Empire State Building in New York, right? Which is, aside from the view deck on top, is still operated for the most part as an office building. So think about what class would that building sit in, right? It's the Empire State Building. It's one of the probably, if someone were to name 20 buildings in the world that you can instantly recognize, it sits in that list, right? So it's a trophy asset. It's a widely recognized building, But is it by merit of that, is it a Class A building, or is it a different class? Because if you look at the building, it's quite dated. The windows in Empire State are smaller than your typical new office spaces. The corridors, the elevator, all have that sort of Chrysler building type era feel to it, and where that can be definitely appreciated from a vintage and historical perspective, because that does carry value. From a utilization and modern sort of quality grade perspective, it's obviously, as Empire State, it's obviously vastly different from, for instance, for those of you familiar with New York, other New York buildings, the Hudson Yards complex, which was developed in the last 3 to 5 years, and is hyper modernized, right? Where every floor has floor to ceiling windows, and there's ample light and open floor plans, and nothing's restricted. There are no narrow corridors. There are vast lobbies with highly amenitized services. There are campuses around those buildings where there's outdoor green space and connectivity to transit and all kind of other features that make that building, from a utilization perspective, much more desirable and a de facto Class A. Whereas a building as the Empire State, and you may think of as a Class A building merely by recognition, is really actually more of a Class A minus Class B building because of vintage and because of the lack of some of these features. So again, takeaway here is it's not always as straightforward or as apparent as may be the case. And so definitely something to be mindful of. So continuing on the segmentation of real estate, and more from an investment perspective, want to spend some time discussing investment styles. So we've talked about vintages and classes, we talked about sectors, and so another categorization that can be applied to real estate is essentially the investment style, which is a categorization by risk return parameters. And so generally, professionals will refer to real estate and strategies as sitting in one of these buckets, being senior debt, which is obviously fairly straightforward and intuitive, but then terms that not everyone may be familiar with, ranging from core to core plus to value add and opportunistic. And so I'll walk through each of these segments, as each of them have their own risk return sort of relationships and parameters. And that part, in essence, holds or translates to traditional investments, right? Where the higher the risk one takes, the higher the return, or the commanded return will be for those investment segments, right? And so real estate is essentially bifurcated on both yield and growth strategies. So let's start there, where yield strategies cater more towards yield-seeking investors. So those are more investors that are just seeking essentially just a yield, not necessarily the upside. And that's more in competition with bonds and other yield products, whereas the growth side of these investments compete more with stock investments and capture a bit more of that upside potential of a good outcome sort of being realized, right? And so both can obviously serve as diversificators in a portfolio, and that yield block, so kind of that senior debt to core plus block, can maybe be a good substitute for bond-like products, whereas that growth block of value add and opportunistic investments can be more of a substitute for stock-based products, right? The return expectations obviously vary across these sort of ranges, but to start sort of at the bottom of this chart, you have senior debt, which is kind of your lower risk return perspective. Generally, it's backed by a first lien position on the property. So the property is essentially the main collateral. And so it's de-risked from that perspective. And that commands, that level of risk commands typically the kind of lowest level of yields. I do have to caveat that this chart and this dynamic is not necessarily black and white. So it's not like senior debt by default always trails core and core plus, especially in this environment. Senior debt yields in some occasions can kind of match or exceed core plus return. So this is kind of conditional on the market, but from a risk return perspective, this kind of block does sit sort of towards this end of the range, where senior debt, core plus, they may shuffle positions, but they're generally at the lower end of the spectrum. So then pivoting away from debt, which I'll cover in more detail on the next slide as well, and more towards kind of general real estate investment strategies, starting with core. So core generally are very low leverage investments, sometimes even unlevered investments in stable or fully leased properties. They tend to generally also be those Class A properties, sort of higher grade, maybe trophy asset properties as well, where the strategy here is not necessarily buying the building and turning it around and improving and releasing and driving all these other value add things. It's more buying the building and essentially capturing that yield, as I mentioned in the yield strategy. which tends to just perform on a stable basis through multiple cycles. And generally, again, this is not black or white and can differentiate depending on the macro cycle, but generally yields an approximate return range of about 6 to 10%. And those core buildings are really an alternative, or can be seen in some extent as parking money essentially to realize a stable yield, and can be a lot more compelling from an investment perspective to somebody super long dated investors, right? Like such as pension funds or insurance funds, to just ensure you're getting a certain yield. There's not a ton of fluctuation. There's not a ton of risk. And so because you're getting a certain yield, you're able to meet those pension liabilities long-term and cater to those demands, right? In that same sphere, you can have kind of a by category, a subcategory denoted as core plus. So core plus are essentially those same core assets, but they require some minor tinkering of a sense, right? So there may be a level of light renovation or touch-ups that may need to occur. So think, for instance, a Class A building that was truly Class A today because it just was developed and completed like in the past few months. But then over the next few years, that building is going to slowly regress and deteriorate in some sense, and it's not going to be as modern anymore. And so it's going to trend towards that bottom end of that Class A range. And as that building may require some minor updates or minor refurbishments or minor releasing of a tenant that maybe leaves and the building is temporarily occupied at 85 or 90%, just needs one or two more tenants to get back to stabilization. Those minor sponsor actions, if you will, qualified as being a core plus building, where by implementing those minor improvements or actions, the building kind of returns back to that true Class A or truly stabilized level and is able to generate those yields again. And obviously, because those minor improvements are being implemented, that generally carries a slightly higher return, because if I'm taking a building and I'm renovating the lobby or the elevators or the common space or the amenities, I can then likely charge a slightly higher rent as a result of that new renovation, right? And so as I charge a slightly higher rent, that then translates into also a slightly higher return. Potentially when I exit the building, it's also slightly more valuable. So I capture a tiny portion on the back end as well. And so that really slots it into that core plus category and generally spans kind of 10 to 15% or kind of low teens returns. Then moving into the sort of more intensive categories, which then also are going to see a larger benefit on the back end, you have value add, which value add is truly kind of sponsor intensive from the perspective that this building or property really needs a significant amount of work, maybe a significant renovation or overhaul, maybe a slight or a complete reposition of the building. So think a conversion of the building from a former office building to now apartment buildings, as undoubtedly we'll see a lot more of, given the shift, the secular shift in office and how that sector has suffered from the transition from work to home, to work from home post-COVID, and how a lot of office buildings are just simply sitting there vacant. You'll see a lot of opportunistic or value-add investors buy these office properties and then spend the capital expenditure or CapEx to reposition these buildings and transform them into apartments, or maybe other, medical office spaces or lab spaces or whatever other use they can sort of utilize. And to kind of pivot back to history, we've just recently seen this in the last cycle, where retail centers and the trend towards online shopping really destroyed a lot of the viability of a lot of malls. And you've seen malls reposition and add grocery and grocery anchored centers, as well as life and fitness and health and wellness offerings, to continue to drive this foot traffic into malls and drive sort of the usability. Or, some malls even functioning as de facto Amazon distribution centers, right? Where Amazon moves in and essentially uses that mall as an industrial warehouse to then send out all the goods to everyone's doorsteps. And so that repositioning that we've just recently seen in the retail space, we'll probably see in office for at least probably the next 5 to 10 years. And that will sit in that value add or sometimes even opportunistic space. So value add, again, it's that heavy lease up. A property may be heavily under occupied because a number of key tenants just left, or property may need that significant amount of renovation or overhaul, repositioning. And because of that and the significant capital spend, it's obviously a higher risk strategy. And then the benefits are being able to return that property to being functional. So also we related back to the classes, maybe take that property from a Class C or D non-functional grade to maybe a Class B functional grade in a different segment, right? So from office to apartments, and being able to, because of executing that strategy, then release that building, get it back to stabilization, and obviously capture the yield, but obviously at the end of successfully executing that strategy, hopefully being able to sell that building that is now converted and operating for a higher valuation than maybe the distressed or bankrupted office building that was bought at the acquisition point in the start of this investment, right? And so that generates the value add returns. And so you'll generally see returns there from 15 to 20%. Historically, is kind of that's the benchmark range. And then as a final category here, we have the opportunistic strategy sphere, where this is truly ground up development. Most of the times, this is truly an operator or sponsor buying a plot of land, getting the entitlements, and having a vision to develop a certain product there, and then going and developing a multifamily building or a single family housing community or a office building or mall or whatever product it may be. And obviously that is one of the most riskiest strategies that can be executed given the uncertainty around securing the entitlements, securing construction financing that may make sense, which is a particular challenge in this high rate environment where construction financing is available, but at the certain rates at which it is available, analytically, that can then complicate the viability of your development, because that's obviously a massive part of your development cost. And so being able to secure financing at a compelling rate is a key factor. And then construction materials themselves are obviously a key component, because you're literally building a property. And so the cost at which you can do that is essentially your acquisition cost, which goes, as with any other investment, towards your returns and profitability, right? And so those all need to align, and because of the alignment and then the complexity associated with zoning and entitlements and approvals and all the other regulatory and environmentally hazard sort of hurdles that can appear during a development project, this is by far the riskiest category. And so therefore also commands the riskiest or highest risk return premium, generally exceeding 20%. And sort of that's obviously almost always all captured at exit, right? As you're developing and building this property over the course of 2 or 3 or 4 years, this property is not going to generate any cash. You're essentially just spending on construction, on the interest, on the construction loan, on all the other costs associated with developing. And then once the property starts being completed, there will be a period of leasing up and getting tenants in, which will generate revenue to some extent, but the building may be 20 or 30 or 40% occupied and not stabilized. And that obviously hurts yields, but then generally you'll see a transition either at completion of the development, selling the property and letting some other sponsor or group take care of the leasing and getting the property stabilization. Or you'll see some developers who will take that on in-house and do that themselves and develop the property, complete it, start that leasing up and stabilization process. And then the minute they hit stabilization, they'll either capitalize on the investment by refinancing the property and getting out of the construction financing and into a long-term loan, which will generally the value of that building at that point exceeds the cost of the development, obviously, if everything is done according to plan. And so getting higher loan proceeds may be opening the possibility of returning capital to investors and generating some return. And in other cases, the developer or operator may exit the building altogether and sell it to a REIT or some other operator that's going to take the building and operate it long-term. And then obviously you're selling it at that stabilized, fully completed value, which should hopefully exceed that development cost by a wide margin and deliver those 20% plus returns. And so that's generally the sphere in which investments sit. So again, to kind of recap as we go here, generally you have a certain sector that you can invest in. You have a certain asset class that denotes the quality grade or the desirability of that building. And then within those two sort of denominators, you have this other label, which is sort of core or core plus or value add or opportunistic, and is an indicator of really the strategy that you're going to employ within these assets and the returns that you're going to pursue. And that's a good segue to the final block in this kind of qualification matrix, if you will, as we're walking through it, which is referred to as the capital stack. And most people will have heard of that as well in passing here or there. But once I have a certain sector that I want to invest in, right? Office, for instance, and I know that I want to invest in Class A or B office buildings. And I know that within Class A or B office buildings, I am interested in value add office buildings where there's some issue, there's some leasing or some dated features that I want to spend money on and improve. And as I deploy that CapEx, then hopefully capture those returns. Okay, great. So now I know the main parameters of my strategy. But then within that strategy, there are different investment slots where you can invest in and further split those returns and that risk and return as well. And so that is denoted by capital stack. And so capital stack is really the position and the exposure you have to that individual investment. And that generally ranges here from senior debt to mezzanine debt to preferred equity, and then LP equity, and finally GP equity. And each of these tiers carry different risks and are subordinated to one another and have different exposures, which I'll walk through. One major thing to denote before we get into each of these categories is that typically you don't see each of these pieces or components in the same deal. So it's not like every real estate deal will have senior and mezzanine debt and pref equity and LP and GP equity. That's actually highly unusual. What you'll see is a combination structurally of these different pieces and components. So you may, for instance, see senior debt and mezzanine debt, and then backed by LP and GP equity. Or you may see, for instance, senior debt and a preferred equity tranche, and then an LP and GP equity position. So there are different combinations that are possible here, but typically you'll usually always see at least GP equity. That's from the perspective of alignment. The GP is generally the group or the sponsor or operator that's executing the actual strategy with the building. And so as an investor, if I'm investing in any project, I would like to see whoever is conducting or executing that project to have some exposure and align their interests or their concerns with my interests and my concerns. And so that co-invest by the GP equity is, in essence, a key alignment feature, and assures that they have some skin in the game alongside my capital, and gives me comfort as an investor that is not involved in the day-to-day execution of the strategy, that the group that is doing that from the purview of capital maintenance and capital adequacy to ensure those returns long term. Usually you'll always see LP equity as well, which is the common investor, which is kind of the vast majority of the equity capital typically, and more of the passive investor. So the investor that wants to invest but doesn't necessarily have the skill set or the expertise or the time or resources to actually execute the strategy. And so they're subordinated, obviously, in that sense. And then usually there's also always a form of debt. There are some categories, as I mentioned on the other slide, in terms of core, that execute strategies on an unlevered basis to avoid the risk and the fluctuations associated with putting leverage on top of investments or structures. But in most investments, you'll see some form of debt, even being at lesser sort of levels, to reduce the amount of equity that is needed and essentially help drive returns, and essentially comprise the structure that way. And so to get a bit more detail on each individual silo or position in the capital stack here, starting on the left-hand side, senior debt is obviously the most secure position, as we covered on some of the other slides. It typically has a primary lien on the underlying assets, so it's secured by collateralizing the asset itself. And so upon default, the lender here would seize control of the asset and can then hold the asset and operate it, which you'll see some niche lenders do, or alternative lenders do. Or if it's a bank that doesn't have that expertise, or another lender, sell the asset at auction and at least realize some proceeds that way. And then a key metric here is the loan to value, which kind of is a key metric across all the different positions in the capital stack. It can also be referred to as loan to cost if you're looking at purely an acquisition. But if you're looking over time, these buildings are typically appraised periodically. And so then there's a periodic valuation that's available. And so you can denote that position in terms of a loan to value percentage. And so you kind of can deduce from the illustrations here in the color tiers, the senior debt is really that sort of shaded foundation of the building. And so that can typically be, from a financial perspective, can typically be 60 or 65% of the building value. And so that really means that 60 to 65% of the value is lent to the operator or sponsored by the lender. And that is essentially the capital at risk. And so if I have a building that's worth $100 and I have a $60 loan on that building, then that's the risk that the lender carries on that building. So if I default on that loan, the building may still be worth 100 or somewhere in the neighborhood of that $100 in original valuation. But the lender is really only interested or only has exposure to $60 worth of that, right? So you can deduce from that if the collateral is worth 100, but I'm lending 60, then I'm sufficiently collateralized to, in most cases, in most scenarios, sell that building in auction or forced manner and still realize at least my $60 worth of capital that I invested from, again, purely a lender perspective, right? And so that security and secure position and being the first in line for that position as well is what generally leads to a lower interest rate. And then the risks with that position are generally the interest rate risk, right? Excuse me. So especially for floating rate positions, the fluctuations in the market interest rates can be a risk to me as a lender, but also the counterparty risk of the borrower going under default or prepaying the loan and having a reinvestment. Excuse me. Oh, excuse me, everyone. That was it's quite a long presentation and it's quite a quick water break, but hopefully everyone's able to hear me normally again. So as I was saying, senior debt, typically less risky position. And again, from a risk perspective, main risks that the lender is concerned about would be the interest rate risk as well as the default risk. So the borrower essentially experiencing some issues to the point of defaulting and not being able to pay back the loan, as well as the reinvestment risk, right? So as a borrower, if there's no prepayment clause, I have the ability to essentially prepay the loan. And as I prepay the loan, that then as a lender returns the capital to me, which is great from a risk perspective. But at the same point in time, I'm forced with a decision to redeploy that capital, and the market may not necessarily be as favorable as it was when I originally issued that loan or made that investment. So that's a certain amount of quote unquote reinvestment risk where I'm going to have to source a new opportunity and at a similar yield, try and deploy that capital. And whilst that reinvestment risk may be covered off by clauses such as prepayment clauses or penalties or things such as yield maintenance or defeasance, there is still a risk involved to me as a lender. But generally, comparing it or contrasting it to the other sectors, this is generally the lowest the lowest interest rate, obviously commensurate with the lower risk as well. And so beyond this category, you really have mezzanine debt, which is kind of a hybrid debt, which is generally subordinated to senior debt, so sits behind that in terms of a priority to the asset, and has a claim on either the residual proceeds, so the proceeds of that sale beyond the senior debt being paid off, or combines that claim with a claim on the sponsor or GP equity. And so the sponsor or GP equity is the equity associated with the platform that is, again, executing the strategy. So once the building or the sponsor defaults and the building is sold, the remaining proceeds after the senior debt will go towards mezzanine debt, but the mezzanine debt may also seize a portion of the GP equity involved in this deal as well. So the key metric here continues to be LTV, which will be looked at from an incremental basis, and that's the case for these other tiers as well. So whereas in that first example, senior debt was at that 60 to 65% portion of the building, as you can see in the shaded area, now I'm adding this kind of light green shaded area on top of that senior debt, right? Where that tranche sits on top of that, and now the building is maybe 75 or 80% capitalized, right? And that's denoted by that LTV. And so because it's still debt, a lot of the same risks continue to apply. There's interest rate risk, there's default risk or credit risk associated with the borrower here. And the higher risk then translates, not surprisingly, to a slightly higher interest rate where I'm being compensated for taking that higher risk and being subordinated. Then a tier up from there, you have pref equity or preferred equity, where, again, that's the incremental layer of capital. Now, because mezzanine debt and preferred equity are not necessarily typically jointly present in the capital stack, so it's either mezzanine debt and then equity, or either pref equity and then the other equity tranches, This may overlap a bit between the green shaded area in the mezzanine debt stack and the blue shaded area here in the pref equity stack. But again, very much from that incremental LTV perspective, where I'm capitalizing my building in addition and above and beyond that base layer of senior debt. And so I'm going up to 75 or 80% LTV again. And again, this pref equity position will be subordinated to those debt positions. So it's again more junior to those other positions, and comes with a more junior claim as well, where it's a claim to the residual out of the result of the debt positions, but it's also compensated through a combination of both a fixed interest rate typically, as well as a participation in the equity upside at exit. And so what you'll typically see, and this differs or differentiates a bit from preferred equity in a sense of typical sort of investment banking or regular company investments, where this is not necessarily preferred stock, where you have certain voting rights or sit in a certain class. This is a bit unique to real estate, where it's preferred equity comprising of a certain base coupon. So an investor is getting a 10 or 12% base rate, almost like an interest rate, but then has a portion that either accrues over the years or a portion that is paid out at exit to get the investor from that 10 to 12% annual rate to ultimately maybe a 16 or 17 or 18% full return at the exit of the investment. So it's a hybrid instrument that combines that periodic annual yield with the upside at the exit, again, to compensate for the higher risk. And so that nature of that structure introduces investment risk as well, where you're exposed as the preferred equity investor to the performance of the investment, whereas as a debt investor, you don't necessarily carry that exposure. And so that, again, translates to that higher interest rate. And then beyond that, you have your traditional equity positions, which these don't have any form of coupon compensation or interim compensation typically. And the LP equity position in this case, which comprises typically the majority of that remaining equity, is essentially subordinated to, again, those debt and pref equity positions, and is really the second loss position if you look at it from the other risk spectrum, so from right to left. The second loss position after the GP equity position is kind of always the first to get hit in terms of any changes to valuation, right? So if my building costs $100 today and it costs $90 tomorrow, that $10 delta and decline is usually fully absorbed by the GP equity, right? And so that's the first loss position. But beyond that any further declines in value sit and get absorbed by the LP equity tier. And so it's on the other side of the risk spectrum. Because of that, it obviously also commands a much higher return and can sit in that kind of 60% plus LTV range, where it's usually kind of the remaining capital aside from both the debt and pref equity positions and the GP co-invest. So it could be 20, 30, 40% of the capital of the entire capitalization of the entire building. And with this particular position or investment, there's obviously the investment risk associated with the building itself, but also to an extent macro risk and how the broader market impacts the investment. And then finally, you have the GP equity position, which again is that first loss position and gains upside through a mechanic referred to as a promote. So a promote is typically an incentive payment where above and beyond a certain return to the LP equity, so call it, for instance, above a 10% return or 12% base return to the equity, any dollars after that point, so after this LP equity investor gains a 12% IRR, any returns after the 12% IRR get split a certain way, where maybe the LP investor gets 80% of that capital, so out of every dollar gets 80 cents, and the GP investor or the sponsor or operator as an incentive gets 20 cents out of every dollar, or 20%, just to incentivize the GP to realize a maximum outcome or a most profitable result, right? And so that split and those mechanics are referred to as a promote or waterfall. This is highly applicable and absolutely a core concept within real estate. If anyone's applying to any roles in private real estate, being able to model that out and analyze that and speak about that intelligently is absolutely crucial to those conversations and to real estate in general, because that is one of the key components that compensates the GPs or operators in that sense. And so that really captures the essence of the capital stack. And then because of mechanics such as the promote, that then is a further dilution mechanic to the LP equity, right? So the LP equity is in that sense subordinated as well. So hopefully that gives a good overview of the different positions in the capital stack. And then to round out our presentation today on real estate and the different categories, I wanted to spend some time before opening it up for questions on the differences between private and public real estate and the different vehicles through which you can invest, right? So most people will be familiar with REITs. These are publicly traded, widely available, very much identical to investing in any stock on the stock market, where you can buy and generally exit in the same manner. And REITs generally offer instant or diversified exposure. They offer divisibility, which is the ability to buy exposure to hundreds of millions, if not billions of millions of dollars of real estate through simply buying a share in a company that invests and holds those assets, which again makes it more accessible, right? Especially real estate is a category where it can take a tremendous amount of capital to be able to invest and buy, obviously, a standalone building, let alone diversify those holdings and or even execute strategies. And so divisibility is really a core feature of REITs, where you can buy a share of Vornado or Avalon Bay, and for that share price, you instantly get exposure to thousands of multifamily units or hundreds of office buildings all throughout the U.S. And that's a great way to get exposure to real estate in that way. And it's obviously liquidity. Those shares are freely tradable generally, and you can enter and exit at sort of your own behest and do that to the stock market. So that liquidity is obviously a benefit as well. And then there's tax benefits, as REITs have generally a tax exemption if they qualify for a certain minimum number of investors, which pretty much all publicly traded REITs do. And they distribute at least a certain portion or the majority of their income to investors in the form of dividends that exempts them from corporate taxes. And so the REIT corporation is not taxed. You as the investor are essentially taxed on your dividend income, and that tax benefit is obviously beneficial to different investors versus being in a structure where you are taxed at the corporate level and then pay taxes on your capital gains, et cetera, as well. Some of the downsides of REITs are that because of their publicly traded nature and liquidity, essentially that comes at the price of a high correlation or relatively high correlation to other publicly traded assets. As the stock market moves and volatility moves, REITs tend to move along with it. And in periods of time where there's high market stress, such as a decade or so ago, when Luis and I were actually doing a training program, and it was the midst of the GFC, REITs were getting abnormally punished by the stock markets and public markets because of the amount of distress and uncertainty that there was around real estate. And some of it was obviously validated, but some of it is public sentiment, and public sentiment can sway that price as well. And so that public sentiment swaying or influence of the stock market and how that sentiment reflects on evaluation for normal stocks can mean that there is obviously the stock trading at a premium or discount to the valuation that, if you do the analysis or you have your viewpoint, you as an investor feel that the stock is fairly or advantageously valued and want to necessarily or can potentially make a decision on investing in it. Whereas for real estate, that same dynamic of a stock being valued at a certain price level comes with another layer of consideration, which is called dislocation, as different to stocks and companies where the value is a bit more intangible, right? Especially tech companies where there's a block of intangible value. Like it's harder to value the actual underlying value of a service or a product, as opposed to when you're looking at a REIT and the core underlying value that's driving the entire vehicle is a series of tangible hard buildings that are located throughout the US, and for which, irrespective of where that stock price is, that portfolio of buildings on each individual market and at each point in time is going to have their own individual values, right? And so that bifurcation, that split, and that aggregate of essentially private values is referred to as a net asset value. And so a net asset value is essentially taking the NOI of the net operating income of all of the real estate assets in that portfolio or in that REIT, and then applying a nominal cap rate, which is essentially an inverse multiple that is used within real estate to value real estate assets and can be done on a market by market and asset by asset basis. and then as such determine the gross value of these buildings, and then obviously aggregate them, and then from those gross values you can adjust for all the liabilities and debt and get to essentially a net asset value. And then the net asset value can be divided by the amount of shares to get to a net asset value per share number, which once you have that net asset value per share number, you can compare that versus the share price. And so here you have the situation where my net asset value number per share can indicate a value of $100 per share, and that should be the de facto share price. But when I look at the publicly traded markets and where the REIT is actually being priced by the public markets, that could be a dislocated price of maybe $60 or $70. So now if I have the opportunity to buy a REIT share at $60 or $70, but the underlying tangible real estate value is indicating to me a price of $100, that is obviously an attractive discount at which I can buy a REIT. And in those types of scenarios, that may make sense to buy shares in a REIT, or even from an institutional level, look at REITs to privatize them. And that's exactly what happens in these moments of dislocation, where for those of us on the webinar today interested in reading more about it, you can read about, for instance, the recent Blackstone and Air Communities acquisition, where Blackstone essentially privatized an entire multifamily REIT. And a large driver of that is exactly that dislocation, especially not to get into too much detail for the end of this webinar, but especially if you factor in the typical premiums that get offered for take privates being in the 15 to 20% range. Again, if I have a stock trading at 60, even at a 15 or 20% premium, my acquisition price is going to be 80 or 85 when it's all said and done. And the intrinsic value that I'm ascribing to these assets is still at 100. If I'm able to buy a bucket of assets worth at 100 for 80, 85, 90 a share, that is still obviously a compelling investment parameter for me as a privatization investor, and I gain most likely a portfolio of diversified assets, institutionally grade operated assets, and a management team that is in place where I have, because I privatized the REIT, the leeway to synergize management as with any other privatization, or even reallocate or trim costs on a management level and operate these assets more efficiently, particularly if I'm maybe a large group such as Blackstone, which have vast in-house capabilities and can essentially fire the entire management of a REIT if that's what they see as fit, and operate the assets within their purview, right? And so these things typically tend to come to the forefront in these dislocation moments, and really are key characteristic of publicly traded REITs. Now, shifting to the private side to round out this slide, you can have anything from non-traded REITs to PERE funds, both open-ended and closed-ended private funds, to obviously direct real estate investments and commingled direct real estate investments, where on a non-traded REIT or fund basis, the benefits are, again, the diversification and usually the visibility, so meaning the more affordability because you're buying a portion exposure to a bucket of assets, versus direct PERE coming at the expense of having to aggregate or raise that capital in full and then be able to make those investments directly, right? So that's usually more pricey. It's usually more of a hurdle to aggregate that capital at that scale. And then beyond aggregating the capital and acquiring these assets, it comes with a level of operational requirements, which may also not necessarily always be feasible, especially as an institutional investor, but even as an individual retail investor as well. Non-traded REITs and PERE funds will offer some degree of liquidity, whereas obviously, as you can deduce from what we covered today, direct investments not being as liquid or far less liquid. And then a couple of the negatives, non-traded REITs and PERE funds can have higher upfront fees, can have different complications around governance or opaqueness around governance. Again, that manager selection that we spoke about comes into play or factors in as well. And some of these can have limited liquidity or redemption restrictions, such as gates or certain hurdles, or investors can only take out a certain portion of capital every year. And so getting capital out of these vehicles can be prohibitive, as well as getting into these vehicles can be prohibitive as well because of certain investor requirements, certain amount of scale or sophistication that is required to even access these vehicles in the first place. Those things are a little bit less pronounced at the direct or private investment side. But even there, again, some of these other operational things come to the forefront, such as local knowledge, having operational capabilities, having ongoing management and oversight in place, right? If you're owning a multifamily property, you can't just own it and collect rents every month. You need a firm that collects those rents for you and bills that through or maintains the property and issues repairs and things of that nature. So that is additional oversight and headache that comes along with direct investments that you don't typically see at the commingled institutional levels. And then finally, commingled direct PRE is kind of the novel space where platforms such as My Employer Equity Multiple, but other competitors as well, such as Yield Street or Fundrise or previously Cadre, offer the opportunity to accredited retail investors to essentially buy into individual single asset investment. So you have a building that is $10 or $20 million, which is an industrial warehouse or an office building. Typically, that's not accessible to you as a wealthy individual, again, with the additional complications of operations and oversight. But through firms such as the one I work at, Equity Multiple, and in other groups, there are certain structures where we pool those resources of those highly accredited investors and aggregate that capital. And then with that aggregated capital, partner with and invest in sponsors and operators. And basically, similar to the other example I mentioned before with the artworks and the sports collectibles, commoditize and democratize these investors' abilities to access these individual assets. And so that is a category that sits at the forefront of accessibility to alts and can infuse that direct exposure into sort of carrying, okay, I own a percentage of building X or building Y, without having the sort of broader REIT complications of the benefits of diversification, but the negatives of the exposure and the correlation, or obviously some of the prohibitive items, such as raising that capital independently or having the oversight on the direct PRE side. And so to conclude today, I wanted to show some research that I've pulled together over the years through my work and refreshed for recent data, which is really that dislocation and how that REIT pricing can differ from the private pricing, and how over time, sometimes you'll see REITs take a massive hit in terms of valuation, but private valuations lingering on and still growing or still being favorable. And so I charted out the private versus public real estate valuations over time. And as you can see on this chart here, you have in the shaded areas in the background, you have the REIT premium or discount to NAV. So essentially when at the zero axis, when the shaded area is below zero, REITs are trading at significant discounts to net asset value or that intrinsic value. And then in the dark purple line, over time, you have the private real estate valuations, which because of the illiquid nature and pricing, I've adjusted for 12 months to account for appraisals. And so if you overlay that 12-month adjusted private pricing line on top of that shaded area of the REIT premium to discount to NAV, you can see that most of the time, the trends are fairly in unison, right? Like as, especially for instance, in the GFC, which is in the middle of the chart, as in the GFC, real estate took a hit across the board, right? Public valuations went down first because that's obviously the most liquid one. And then shortly thereafter, you see private valuations follow and bottom out as well at significant discounts, right? And significant decline rates. And so generally, this relationship tends to hold. But there are periods, such as shaded in the boxes, where there is dislocation in the market, and you can see that private valuations are pulling back, but are still growing, so are still above zero, whereas the stock market is already being penalized and is trading at 20% plus discounts to NAV. And so exactly in these windows is where you'll see institutional investors, especially savvy groups, do the analysis on certain REITs, assess the viability of take privates, and then come in and privatize these groups and essentially capitalize on that valuation dislocation and essentially gain access to that diversified portfolio of assets at an attractive valuation. And then maybe if they have the operational capabilities, such as the Blackstones of this world, realize additional operational synergies on top of that and really turn that investment into potentially a highly lucrative investment, right? And so I think this is a good point to conclude and really summarizes some of the bits and pieces we covered today, where alternatives tend to be more opaque. They tend to be a lot more complex in your vanilla investments. And because of that complexity, manager skill, being able to identify these types of relations, these types of market type drivers and components becomes a core component, right, of assessing and successfully executing these investments, and then obviously driving those alpha driving portions of returns and differentiated returns from your traditional investments. So I'll pause there and gladly open it up for any questions today. Thanks everyone for sitting through this and attending this.
Thank you, Charles. This is pretty insightful, and the data that you're sharing, I think gives everyone more insight into structuring portfolios when you're integrating the alternative space. I had a question in terms of employment and recruiting for alternative investment. I know you mentioned that many private wealth or family run funds are typically investing in private markets and in the alternative space. But from a recruiting standpoint, where do you see employment and what's the trend for firms recruiting individuals that want to break into the alternative investment space?
Right, that is an excellent question. And one that I can actually speak to evolution of the space in terms of my career as well. So when I first got into alternatives and real estate investment banking and PRE, this was kind of early 2010s, 12 and 13 and 14 and so on. A lot of the institutional investors, even at that point, were starting to allocate more aggressively to real estate. And when I say that, it's more aggressively to direct real estate ownership. So you had a lot of the institutional pension funds and insurance funds and companies that wanted that allocation within those portfolios, right? As I alluded to with Yale and Swensen and the investment models. And as they expanded into the space, didn't necessarily at that point have the in-house capabilities or know-how. And actually, at that point in my career, relied a lot on firms such as the ones I worked at to really assist them in getting a view or getting the analysis done to be able to invest in those groups. And in the example of Macquarie specifically, one of the firms I worked at, even partnered sometimes with Macquarie to come in those investments. So in one of the deals I worked on for the American Dream Mall, Macquarie partnered with an institutional Canadian fund. And as such, we jointly analyzed and jointly invested in the development loan for the development bridge loan for that mall. And as such, gained exposure to that both from our bank perspective as a merchant or investment bank and the merchant side of our business, but also for the pension fund out of Canada to gain exposure in their portfolio. Now, over time, as the industry has evolved and those exposures have picked up and the alternative investment space has grown, what I've seen is a lot of these groups have started to bring those teams in-house because they want to have the in-house knowledge and the in-house analytical capabilities and monitoring to essentially make more educated decisions and make better manager picks. And so as the groups have started to hire these positions in-house, the job field has grown exponentially, right, as you can imagine. And I'm seeing this now today, fast forward to today, in terms of the family offices, and a lot of family offices traditionally investing in your kind of vanilla bonds and stocks, but now wanting to gain exposure increasingly to factors and sectors such as real estate. And then because of that, being interested in hiring real estate teams and groups of professionals who have the ability to underwrite and analyze these real estate components. And to look at sort of the supply side of those positions, this is not all staff and professionals coming out of pure investment banking roles or coming out of investment banking and then transitioning to PE and then landing in the alternative space, right? PE is obviously alternative space, but to land from investment banking generalist to maybe PE at a generalist fund to maybe being at a PRE shop is kind of another bridge, right? And so you see obviously that transition, but a lot of the PRE shops, as I specifically speak to my field, they recruit aggressively from brokerage shops and investment sales shops as well, as these are people that are on the ground and are property management and asset management people as well, I should say, because these are people that are on the ground and are adept at analyzing and modeling these real estate assets at the ground level. And that expertise and that skill set can translate and actually pivot you or propel you into a PE career where you're in PRE and you may have never even set foot in investment banking or in traditional PE. And you've kind of progressed into that space from being a former broker or former investment sales rep that has just built so much experience in underwriting these assets to the point where you can carry that and become more institutional. And to round that out, I would say that obviously I'm biased because I hold a CAIA myself, but out of all the different continuous education and things that I've pursued, an additional certificate or charter such as CAIA can be an invaluable tool to help qualify you from an academic or theoretic perspective to have the know-how beyond just executing on the job as maybe a broker or investment salesperson or having some other exposure because you're managing properties or asset managing, to having a better institutional grade understanding of, okay, I understand the assets, but on the other side, how do we underwrite this? How do we structure the investments? Where do these capital positions sit? What are the rights and the due diligence associated with each? And that I really gained from CAIA and from some other continuous education programs. So for anyone interested, I would definitely recommend pursuing that. And if you have a combination of that tangible work experience and exposure paired with some solid academic or fundamental knowledge, you should be absolutely able to qualify for a variety of positions in the PRE space. Doesn't all have to be, and in all honesty, won't likely be immediately at Blackstone because that's much more of a traditional blue chip path. But there are literally thousands of shops out there that are doing real estate investments at all levels, at all different regional markets that are very much PE players and PE shops, and where you can execute exactly some of the things we spoke about today and be compensated just as lucratively, if not in some cases even more lucratively than being at the larger shops. So.
Great. Thank you. Does anyone else has any questions, comments to contribute before we wrap up today's session? Still see a couple of guys here: Parker, Lucas, Eddie, Vishnu. All right, great.
I'm happy to do questions separately as well if there's any follow-on questions or people contact the platform or LinkedIn. But,
Well, I know this was a lot of information thrown their way. I think this was insightful as well, including for me. I got to get some insight into the performance. I forgot which firm was it that was doing the comparison between equity bonds and including alternative investments. And over time, you got to see the optimal portfolio. Yeah, this structure right here, 20% on the alternative side, has a little over 9.5% return. I mean, this is pretty interesting. And who ran this?
It's a JP Asset Manager.
Okay, interesting. The problems that I have sometimes on the alternative space is that they're illiquid, right? And there's only so many competing asset classes out there, or even products that you can go after, that I'm even wondering, is it becoming a saturated market? And does it get to a point where there's just not that much investment opportunities out there that would cause the portfolio manager to probably start making decisions that otherwise they wouldn't make because they're chasing returns? Is that something that you've seen at your firm or within your career, where they're chasing returns even though they shouldn't be making those private investments just because they have that exposure to the alternative space?
Yeah, that's another good question. I would split it into two camps. I would say you have your institutional allocators, right? Your large pension, sovereign, insurance funds. Those have evolved to a position of sophistication or carry such a burden on the investor responsibility side that they're not necessarily engaging in the behavior of pursuing returns that aggressively. It's much more conservative than that. The space has actually also evolved over the decades to very slowly, progressively allocate piecemeal, increasingly sort of more towards alternatives. So that's more of a slow evolution, more of a deliberated sort of choice. But at the other side of the market, in the family office category, specifically in recent years, as there's so much coverage and so much exposure on alts and the benefits of alts and how they can propel returns and offer all the components we talked about today, you do see a lot of groups that are maybe not as well positioned or not as considerate of longer term considerations, right? And also, just as a family office, you have a bit more of that freedom, right? Which is a key characteristic. Like, you're not necessarily beholden to a pool of pension holders and providing for them, or having an insurance risk exposure of claims that you have to cover. You're more concerned with family X and their wealth management. And obviously, your goal is not to destroy the wealth of the family or deteriorate that, but there are broader parameters, because you're usually not managing to a certain yield requirement or target. And so that gives you more freedom. And then you see the increased coverage and attention paired with that increased freedom on decision making. Yeah, you do see that result in some decisions that get made to go into certain investments that may not necessarily always be the best ones. And that then in itself ties to that manager selection slide that I put up, where because of the opaqueness of the market, because of the different considerations, I cannot stress enough how selecting the right manager is absolutely key, and doing adequate due diligence and having the adequate in-house staff to do that. And I do unfortunately think that you see some family offices that hire maybe a generalist CIO or even outsource a CIO and get placed or pushed and or incentivized somehow to go into a certain investment with a certain group, and may not necessarily realize group ABC, who has never done a development project ground up and who's now raising capital to build an office building for the very first time in that firm's history ever, that may not necessarily be a great group for you to cut your teeth on in terms of gaining the alternatives, right? But you do see that happening, and then the full risk and burden of that investment rests with that group. And because it's a singular investment at that, there's the compounded risk where if that development doesn't work out, now you've wiped out your entire alternatives exposure in the portfolio. So you do see that. So for those groups, I would recommend a combination of, going back to your hiring question, bringing more adequate staff in-house, and or going or cutting your teeth into the alternative space in more diversified products. So maybe a fund of funds, maybe some other diversified open-ended fund where it's not just one real estate project, but it's multiple ones. And it's not maybe necessarily at the utmost end of the risk spectrum in development, but it's maybe more core plus, just to get a feel for the space and at least ensure a degree of capital preservation.
All right. Thank you. Thank you. All right. Well, I guess we'll wrap it up here. Most of the guys are probably just listening and being quiet, but we are going to post this up on our platform. I think it's a great resource to go back, watch, replay, especially for those that are going to have any upcoming interviews in private equity, real estate, or even investment banking. I think this is very beneficial. Thank you, Charles, for putting all this material together. Again, very informative. I appreciate it. We'll definitely stay in touch. Once we have this available, we'll share the link with you. And for everyone else, we'll continue our usual webinar next weekend. We'll dive into the markets. We'll do some valuation. And for those of you still going through training, we'll definitely touch on phase 1 of training as well. All right, folks, enjoy the rest of your weekend. Thank you. And Charles, once again, thank you for putting this together. Very insightful.
Absolutely, Luis, and everyone else on the webinar today. Absolute pleasure to be here. I'm seeing some messages come in from Lucas and Eddie. Appreciate the positive feedback and the compliments here. Again, my pleasure to share this today. I guess maybe briefly to end there. For anyone interested in reading more about this, you can check out the CFA blog or the CAIA blog. I'm kind of promoting my own content, but I've actually written a number of articles that cover these topics in more detail on the CFA blog, The Enterprising Investor, so you can get some more reading there as well. And then if you want to really get into the weeds on the reports or research I shared, you can pretty much source all of the charts, all the data that I've shared here today through the Savvy Investor platform. So feel free to check that out and spend time reading. And again, happy to take additional questions on the platform or LinkedIn or whatever means you.
Great. All right. Thank you, Charles. Thanks, everyone. Have a good one. Bye-bye.